Our sort of guest on the program is a special one. James Sullivan is joining us. He's Managing Director, Asia Pacific Equity Research at JPMorgan. James, great to have you back on the program here on CNBC TV18. Happy New Year from all of us here. So great to see you. Prashant this side. I mean, the big talking point and the unknowable in that sense is what happens to the US economy. Will we see a recession or not? The consensus is that we will not. History tells us otherwise. What's the JP Morgan view, and what does it mean for markets then?
Thanks very much for having me on the program, and Happy New Year to you and your viewers as well. I think the critical thing to focus on here is really expectations that are priced into U.S. markets relative to potential reality. The reality is that markets are pricing in an extremely aggressive view right now. You're looking at about a 70% odds of a rate cut in March. JP Morgan view is that it will be June at the earliest. Markets are pricing in over 140 basis points of rate cuts by the end of the year. JP Morgan's thinking somewhere around 120. And so you have very aggressive forecasts already built into rate markets at this stage, which we think are likely to be disappointed. The incremental macroeconomic data indicates that you're still seeing inflation at reasonable levels. If you break down the inflation view into its subsidiary components, on the goods inflation side, you've seen a significant move down as supply chain pressures have eased. However, for the first time in history, you now have medium-term problems in both the Panama as well as in the Suez Canal. Those are not going to get better in the short term. You're seeing massive increase in freight rates for a lot of routes, particularly from Asia to Europe and Asia to the United States, which will put further upward pressure on goods inflation. On the services side, you're still seeing relatively strong labor markets in multiple economies around the world, and we don't think you'll see disinflation on that side. And so the setup at this stage is potentially for a market disappointment and for higher rates relative to current expectations at year-end.
Okay, so there's a massive increase in freight rates that has already occurred, right, James, because of the escalation at the Red Sea, and now things are only getting worse. So I take your caution on board for sure. How do you think our economy would react to that? We're heading into a vote on account, and there will be a full-blown budget in July as well. Given that we have these kind of geopolitical, this turmoil, what is your own expectation from the Indian budget?
So I think the coming year in India is going to be absolutely fascinating from a macroeconomic perspective. The most important thing to watch from my perspective is the case of the missing FDI. The narrative in a lot of the popular press has been India as a prime beneficiary of supply chain relocation. And you've seen company-specific announcements out of companies like Apple that are continuing to ramp manufacturing capabilities in India. Obviously, the government's Made in India program is supportive of that as well. That is, however, not in fact occurring in the actual world. India has driven FDI of about 40 billion US dollars over the course of the last couple of years annually. Trailing 12 months is only at 13 billion, and we're looking at a best case scenario of 20 billion for the current year. So significantly below trend. That number is of critical importance for two reasons. Number one, your overall Indian balance of payments was propped up by 21.4 billion US dollars in portfolio inflows last year, the highest across global emerging markets. Strong start to this year, as you said earlier in the program, with about 1.1 billion in portfolio inflows year to date. But it remains to be seen if it can be at that elevated level for the rest of the year. And then critically, the core support for the Indian economy has really been government-driven CapEx. The central government has stepped up with a very significant CapEx program. However, it spent most of it. And if you look at the way the budget works out, federal CapEx was up 16% in the first half of the fiscal year. That implies it will only be up 1% as we look at the second half of the fiscal year. You've seen a very strong step up in state-level CapEx, but that's off a very low base. And so the overall drivers of the Indian economy get very, very interesting as we look forward into the second half.
All right. Hi, James. Good morning and good to see you, Ben. James, the last time we chatted, we were discussing about how China, well, it's been an underperformer. Economic data is not showing up. But at those valuations, maybe things are looking up. The problem is the economic data is still weak. How would you approach that market in this toss-up between India and China?
Look, it's a great question. And again, it's expectations versus reality. JP Morgan forecast for China GDP growth this year is at 4.9%. The market's only at 4.5. And so, yes, the story is not fantastic, but that is very, very well known. And investors are extremely underweight China from a portfolio perspective. So we feel as though expectations have been rebased to a level where you now could start to see some positive inflection, not in reality, but in expectations. And so we don't necessarily need to see a significant strengthening in macroeconomic numbers from here to see upside to portfolio inflows as well as GDP forecasts for China.
Okay.
James, you said you're expecting net FDI to be $20 billion in 24 in India?
So the trailing 12 months is actually only 13 billion. If you look at the best case outlook for the full year, we're looking at around 20. And again, that's in the context of a trend over the course of the last 5 years of over 40 billion US dollars. And so inbound FDI is not coming. We're not seeing global multinationals make the bets that it seems like they're making if you only read the headlines.
Yeah. No, I take that point. Maybe we'll have to look at the numbers. I don't know if you, because in 23, we had an extraordinary amount of sales from, private equity, and that I think when you net out the numbers, gross inflow and outflow, maybe the outflow number was very large because of this. I'm not sure if that is a factor per se.
So the way that we're calculating FDI takes that off the table. I think that the critical thing that we're looking at from an investor expectation perspective is this belief that multinationals are keeping their powder dry until we get past the political season in India. The expectation is that if you get a reconfirmation of particularly central government policy, that you could see that influx that we've been waiting for. And so that's really what we're watching for from a second half perspective.
All right. Well, James, we'll leave it at that. Thanks a lot for joining in and giving us your view on the markets as well as on the way forward. That's James Sullivan talking about how this could be a tricky year for the global markets given the kind of escalation that we have in the Middle Eastern conflict, and the way crude has been moving up. So not too sanguine about the equity markets. Let's